Let's start with the most critical truth in investing. The first rule is, don't lose money. The second rule, never forget the first. Sounds simple, but it's the hardest thing most investors will ever fail to learn. People lose money not because the market conspires against them, but because they conspire against themselves. They chase noise, believe stories, and ignore arithmetic. The market doesn't punish intelligence, it punishes emotion pretending to be intelligence. You see, investing isn't about finding the next rocket stock. It's about avoiding stupidity. In fact, if you can just avoid doing dumb things consistently, you'll look like a genius over time. Compounding doesn't need brilliance, it needs survival. Let me walk you through the 8 key disciplines that protect you from permanent loss and separate real investors from gamblers. The biggest mistake most investors make is starting with the question, how much can I make? Instead of, how much could I lose? Real investing begins with defense, not offense. It's easy to get seduced by potential returns, but the real secret of long-term success is staying in the game. One bad decision, one overconfident bet, one uncalculated risk can wipe out years of progress. Protecting your downside isn't pessimism, it's survival instinct in a world where optimism without logic destroys wealth. Every great investor knows that avoiding catastrophe is more important than chasing perfection. The market doesn't reward bravery, it rewards prudence. When you think about risk first, you automatically start filtering out foolish ideas. You stop touching things you don't understand, and you stop chasing trends you can't control. Protecting the downside means understanding the limits of what you can bear emotionally and financially, and never stepping beyond them. The real challenge is emotional. Greed whispers that you're missing out, that everyone else is getting rich faster. But the truth is, they're often getting rich quick and poor quicker. When you anchor your strategy on not losing money, you start thinking like a survivor, not a speculator. You focus on durability, not excitement. You start caring about margin of safety, diversification, and the quality of what you own. Risk control isn't about being cautious for the sake of caution. It's about being rational when everyone else loses their mind. Protecting your downside forces you to ask hard questions. What if I'm wrong? What if the world changes? What if my thesis fails? Those questions don't make you timid, they make you wise. Hope is a wonderful human emotion, but a disastrous investment strategy. Most people invest in stories, not statistics. They buy because they want something to work, not because the odds actually favor success. The professional investor thinks in probabilities, not possibilities. Every decision is a calculation. What are the chances this works? And what happens if it doesn't? When you trade hope for arithmetic, you stop gambling and start thinking like an owner. The market rewards those who treat uncertainty with respect. Nothing is guaranteed, not even the safest looking stock or bond, but you can tilt the odds in your favor by focusing on what's measurable. Valuation, balance sheet strength, competitive advantage, management quality, and price paid. Probability-based thinking removes emotion and replaces it with logic. It's not about knowing the future. It's about preparing intelligently for whatever the future delivers. Hope-driven investors always look for confirmation. Probability-driven investors look for disproof. The former seeks validation, the latter seeks truth. If you're only looking for data that agrees with your belief, you're no longer investing, you're daydreaming with money on the line. Real discipline comes from constantly asking, what's the likelihood I'm wrong? And adjusting your position size accordingly. You don't need to be right often. You just need to avoid being catastrophically wrong. Thinking in probabilities also builds humility. It reminds you that even the best analysis has limits. You stop pretending to control outcomes and start managing risk. You stop chasing perfect predictions and start focusing on sound processes. The world is too complex for certainty, but it always rewards those who make consistently rational bets where the odds are quietly in their favor. In investing, time is the most underappreciated advantage. Everyone wants to act, trade, and do something, but almost no one wants to wait. The irony is that markets are designed to transfer wealth from the impatient to the patient. Patience isn't about sitting idle. It's about having the discipline to wait for high probability opportunities and the restraint to do nothing when those opportunities aren't present. The hardest skill to master isn't analysis or forecasting, it's self-control. Most people lose money because they mistake movement for progress. They think constant action means productivity, when in reality it's just noise. The market rewards inactivity far more often than impulsive behavior. The best investors spend 95% of their time waiting and 5% acting decisively. They understand that compounding doesn't happen in minutes or months. It happens quietly over years. Patience allows compounding to unfold without interruption, while impatience keeps resetting the clock. Patience also protects you from emotional mistakes. When everyone around you is chasing the latest hype or panicking over headlines, patience acts as armor. It keeps you grounded when the crowd is losing its mind. Most people don't have the temperament to watch others get rich quickly without joining in, and that's why most never achieve lasting wealth. The ability to wait calmly when others are frantic is not natural. It's learned through discipline and pain. Markets constantly tempt you with short-term noise disguised as opportunity. A sudden price drop, a breaking news story, or a viral prediction, all designed to trigger reaction. Patience is the ability to look at that chaos and do absolutely nothing. It's understanding that your portfolio is a long-term machine, not a slot machine. You don't get rewarded for how often you act. You get rewarded for how well you think before you act. The real edge patience provides is psychological stability. It gives you clarity when fear or greed dominate others. It lets you see opportunities rationally instead of emotionally. It turns volatility from an enemy into an ally because you know time smooths out noise and reveals value. The patient investor doesn't need to predict the next quarter. They need to survive the next decade with their sanity and capital intact. Patience isn't passive, it's power under control. It's the quiet confidence to let compounding, discipline, and rationality do their work without interference. The world celebrates some speed, but wealth compounds in silence, in stillness, in the willingness to wait while others chase what doesn't last. Leverage looks like a shortcut to wealth, but it's really a shortcut to ruin. It magnifies everything, your intelligence, your emotions, and your mistakes. The problem is that most people only see the upside of leverage when things go right and forget that it destroys faster than it builds when things go wrong. A good investment with bad leverage can still kill you. The market can stay irrational longer than your margin call can wait. Debt turns temporary volatility into permanent loss. Without leverage, a 30% market drop is painful but survivable. With leverage, it's fatal. Investors tell themselves they'll get out in time, but panic never sends a calendar invite. Margin calls don't care about your confidence. When you borrow against your investments, you surrender control of your timeline to market chaos. That's not investing. It's gambling with borrowed matches in a dry forest. The allure of leverage is psychological. It feeds the ego, the idea that you're smart enough to use it wisely, that you'll be different. But history is littered with geniuses who blew up because they thought they could manage risk faster than markets could move. Leverage makes you impatient, shortens your time horizon, and amplifies your emotional reactions. It doesn't just magnify financial risk, it magnifies human weakness. Real wealth isn't built on borrowed money, it's built on patience and prudence. If your idea needs debt to look attractive, it's probably not a good idea. Leverage makes fragile what should be robust. It creates a dependence on perfection. No mistakes, no surprises, no downturns. But perfection doesn't exist in markets. What exists is randomness, and leverage multiplies its consequences. The most dangerous part about leverage is that it works until it doesn't. The returns look smooth, consistent, even brilliant, right before they collapse. It's like watching someone juggle knives, impressive, but only until they miss. A small miscalculation, a sudden event, a single wrong assumption, and the whole structure falls apart. Leverage doesn't give warnings, it just detonates. You don't need leverage to get rich. You need time, discipline, and patience. Leverage tempts you to accelerate what should unfold naturally. It offers speed at the cost of safety, excitement at the cost of endurance. In a game where survival is the ultimate goal, introducing a weapon that can kill you instantly is not a strategy, it's self-sabotage disguised as sophistication. The most dangerous words in investing are, "I'm sure." Confidence feels good, but it's often fatal. The market doesn't reward arrogance. It humiliates it. The moment you believe can predict the unpredictable, you've already stepped onto thin ice. The best investors aren't the ones who know everything. They're the ones who know exactly where their knowledge stops. Recognizing ignorance isn't weakness. It's strength disguised as humility. Most people lose money not because they're dumb, but because they can't admit uncertainty. They cling to illusions of control, trying to forecast interest rates, commodity prices, or political outcomes. But the world doesn't bend to anyone's models. Reality is too complex, too random, and too indifferent. When you accept how little you truly know, you stop trying to predict and start preparing. You stop gambling on events and start managing exposure to risk. Knowing what you don't know creates clarity. It keeps you from wandering into areas you can't evaluate, companies you don't understand, assets you can't value, technologies you can't explain. The rule is simple. If you can't describe how something makes money in one sentence, you have no business owning it. Ignorance becomes dangerous only when it's denied. Once it's acknowledged, it becomes your shield. This mindset also builds discipline. It forces you to specialize, to stay within your circle of competence. You don't have to know everything. You just have to know your lane and stay in it. The biggest fortunes have been built by people who mastered a narrow field and ignored the rest. The moment you start thinking you can figure it all out, the market will remind you that overconfidence compounds faster than capital. Knowing your limits also helps you resist hype. When everyone around you claims they've discovered a new secret to getting rich, awareness of your ignorance saves you from the madness. You can calmly say, "I don't understand it," while others are busy convincing themselves they do. That simple sentence, "I don't know," has saved more money than any trading system ever invented. Uncertainty isn't something to eliminate. It's something to respect. Once you respect it, you stop pretending to be a prophet and start thinking like a risk manager. You hedge, you diversify, you stay liquid. You understand that survival matters more than brilliance. The investor who admits ignorance will outlast the one who mistakes conviction for competence. This kind of humility also encourages learning. Admitting what you don't know keeps your mind open, curious, and adaptable. The person who believes they already understand everything stops listening, and that's when they fall behind. Markets evolve, industries shift, and new risks emerge every year. If you're not learning, you're decaying. The humble investor adapts faster because they never believe they've arrived. There's a reason the wisest investors sound cautious, even after decades of success. They know how little can be known with certainty. They've seen enough cycles to understand that humility isn't a posture, it's protection. The world is unpredictable, and the investor who accepts that truth walks lighter, thinks clearer, and avoids the fatal illusion that knowledge equals control. The market runs on stories because people hate math and love drama. Narratives are exciting. They make us feel smart, hopeful, and part of something bigger. Every boom begins with a story, a new technology, a new era, a new paradigm. But behind every spectacular crash is the same story that went too far. The numbers were whispering caution while the narrative was screaming riches. The crowd always listens to the story because it flatters emotion. Numbers, on the other hand, tell the uncomfortable truth. Stories can sell anything, from worthless startups to overhyped stocks, because they appeal to imagination, not analysis. A great story bypasses logic and goes straight for greed. It paints pictures of unlimited growth, unbeatable innovation, and inevitable success. But numbers don't care about imagination, revenue, earnings, cash flow, debt. They're cold, emotionless, and brutally honest. When the numbers and the story disagree, the numbers win every time. The problem is that people want to believe. They don't want analysis, they want reassurance. That's why bubbles form, because a good story gives permission to suspend disbelief. When you hear lines like, "This time it's different," or "You don't understand, it's the future," you're hearing the soundtrack of a coming disaster. Numbers may look boring next to grand visions, but they are the only defense against self-deception. Numbers anchor reality. They tell you whether a company actually earns money or just burns it. They show whether growth is sustainable or borrowed. They expose whether management is creating value or just selling dreams. The investor who focuses on data builds conviction based on truth, not fantasy. The one who falls for stories builds castles in the air and calls it strategy. Stories also have a way of infecting intelligence. Even seasoned investors start bending numbers to fit their beliefs instead of letting numbers shape their beliefs. Confirmation bias turns storytelling into self-deception. The smarter the person, the more elegant their excuses. That's why rationality is rarer than intellect in markets. It requires surrendering your ego to the evidence. The best investors let the story get their attention, but they let the numbers make the decision. They use narrative to understand the business model, but they use data to judge its quality. The financial statements are the X-rays of a company. They don't lie if you know how to read them. It's fine to be inspired by a company's mission, but you should invest in its performance, not its poetry. You don't need to be a mathematician to understand numbers. You just need the courage to face what they reveal. A great business doesn't need constant storytelling. It tells its story through consistent profits, strong balance sheets, and growing free cash flow. The louder a company has to talk, the weaker its results usually are. Noise is often camouflage for weakness. When you learn to trust numbers over narratives, you stop being swayed by hype cycles and emotional headlines. You stop reacting to opinions and start responding to facts. You stop investing in promises and start investing in performance. The market will always tempt you with stories that sound irresistible, but truth lives quietly in the data that most people ignore. In investing, brilliance is overrated. The world is full of highly intelligent people who never built lasting wealth because they lack consistency. Intelligence helps you find good ideas. Discipline ensures you don't destroy them. Markets don't reward those who know the most. They reward those who can control themselves when it matters most. The ability to think clearly under pressure is worth far more than a high IQ. Discipline is what keeps you rational when the crowd loses its mind. When prices soar, greed whispers that you're missing out. When markets crash, fear screams that everything is doomed. The disciplined investor does neither. He stays steady, guided by principles, not emotions. This calmness isn't natural. It's built through experience, loss, and repetition. Every rule you follow when it's hardest to do so strengthens your edge. Most investors know what they should do, but few actually do it. The difference isn't knowledge, it's discipline. Everyone says, buy low, sell high, yet when panic hits, they sell low out of fear. Everyone claims to think long-term, yet they check prices every hour. Knowledge without discipline turns wisdom into trivia. Knowing doesn't make you rich, doing does. Discipline is the quiet refusal to react to noise. It's ignoring headlines, ignoring predictions, and ignoring people who claim certainty. Markets will always tempt you to break your own rules. They'll test your patience, your ego, and your convictions. Discipline is saying no when everything around you says yes. It's the ability to wait for clarity instead of forcing action. Even the smartest analysis becomes useless without emotional control. A great investor can be right about a company's value and still lose money if they can't stay calm when volatility hits. Emotional discipline, staying steady during chaos, is what separates successful investors from clever amateurs. It's not brilliance that keeps you in the game. it's temperament. Discipline also means having a system and sticking to it. That system could be as simple as buying quality businesses at reasonable prices and holding them. It's not about complexity. It's about consistency. Most people abandon their systems the moment they face discomfort, chasing whatever seems to work this time. The truth is, no system works all the time, but a disciplined one works over time. Markets punish impatience and reward endurance. The investor who can sit through boredom, doubt, and temporary pain will almost always outperform the one who chases excitement. Discipline helps you survive the waiting periods when nothing seems to be happening. Those who can't stand still end up transferring their wealth to those who can. The disciplined few quietly collect, while the restless many chase illusions. Another form of discipline is humility. It takes restraint to admit mistakes early instead of doubling down to protect your ego. Selling when you're wrong, cutting losses, or holding cash when opportunities aren't clear. These are acts of discipline disguised as inaction. The market doesn't care about your pride. It only rewards correct behavior repeated consistently. Discipline protects you from the two most powerful destroyers of wealth, greed and fear. Greed makes you buy too high. Fear makes you sell too low. Without discipline, both emotions will own you. With discipline, you learn to use them as signals. When greed dominates the market, you prepare to sell. When fear dominates, you prepare to buy. Emotional mastery is the highest form of discipline. Even brilliance can't predict the unpredictable. But discipline prepares you for it. The disciplined investor doesn't panic when things go wrong because they've already accepted that things will go wrong. They build portfolios, not predictions. They think in probabilities, not fantasies. They expect volatility, not perfection. Discipline turns chaos into opportunity by refusing to react impulsively. You don't need genius to compound wealth. You need a plan you can stick to when it's hardest. Discipline gives you that steadiness. It's the reason some investors build fortunes while others, equally smart, build excuses. In the end, markets aren't contests of intelligence. They're endurance tests of character. The person who stays calm the longest usually wins. Brilliance shines for a moment. Discipline endures for a lifetime. The market doesn't remember the clever trader who made one lucky call. It remembers the investor who survived every cycle, kept emotions in check, and let time do the compounding. The secret has never been extraordinary intelligence. It has always been ordinary discipline applied with extraordinary consistency. Compounding is the closest thing to financial magic that exists. It's the process of money earning more money, which in turn earns even more. The concept sounds simple, yet almost no one truly lets it work long enough. People underestimate the quiet power of time because it doesn't feel exciting. There's no instant reward, no visible progress at first, just patience and faith in arithmetic. But those who understand compounding know that the real miracle happens in the later years, when small gains start snowballing into unstoppable growth. Most investors interrupt compounding because they can't sit still. They buy, sell, tweak, and tinker, mistaking motion for progress. Every time they act unnecessarily, they reset the clock on growth. The human brain is wired for activity, not patience, and that's why compounding feels unnatural. The discipline to do nothing, absolutely nothing, when logic says to hold, is one of the hardest and most profitable behaviors in investing. Compounding rewards time, not brilliance. You don't need to find the next big thing or time the market perfectly. You just need to avoid blowing yourself up. Avoid big losses, stay consistent, and give time room to work. Most fortunes weren't built by chasing opportunities. They were built by sticking with good ones long enough to let compounding reveal its power. The math of compounding favors endurance over excitement. The key is to protect the process. Compounding only works when you stay invested. Selling because of fear, reacting to headlines, or trying to outsmart short-term volatility interrupts the rhythm. Think of compounding as a tree. You can't keep uprooting it to check the roots. You plant it, water it, and wait. The shade it gives later depends on the patience you showed earlier. Interrupting compounding is like stopping a marathon at mile 20 because you're tired of running. The reward was always at the end, but impatience made you quit before it arrived. Investors do the same when they sell great assets for small profits or bail out during temporary declines. They trade long-term power for short-term comfort, not realizing that not timing, is what builds wealth. Compounding also demands emotional stability. Markets will rise and fall, but the compounding machine doesn't care. Its job is to keep working quietly in the background while investors panic in the foreground. The moment you let fear or greed dictate your actions, you interfere with the mechanism that could have made you rich. Staying invested through chaos isn't just courage. It's understanding how compounding thrives on time, not tranquility. Another reason investors interrupt compounding is the illusion of control. They believe they can optimize returns by moving in and out of markets or adjusting constantly. But every unnecessary move invites friction. Taxes, fees, mistakes, and missed opportunities. The greatest investors understand that inactivity is often the most active decision you can make. Patience isn't laziness, it's precision. Compounding doesn't demand brilliance, it demands faith and consistency. You invest wisely, stay the course, and let mathematics take care of the rest. Even modest returns, held over decades, become extraordinary through the exponential effect of time. But the trick is that you rarely feel progress while it's happening. It's invisible for years, and then suddenly undeniable. That's why compounding is called the eighth wonder of the world. Few respect it, fewer master it. The real challenge isn't building a compounding strategy, it's surviving long enough to let it work. That means avoiding leverage, speculation, emotional decisions, and the need for instant results. Compounding can't protect you if you're constantly interrupting it with mistakes. Survival is victory because time only rewards those who remain in the game. Compounding also thrives on reinvestment. Every dollar earned must go back to work. The temptation to consume too early is what stops wealth from multiplying. Those who delay gratification, who let their money breed instead of bleed, unlock exponential growth that can't be replicated any other way. Wealth isn't built by what you make, it's built by what you keep compounding. The beauty of compounding is that it works even when you're not paying attention. It doesn't require constant oversight or genius-level insight. It rewards the investor who plants good seeds and simply leaves them alone. But this simplicity is deceptive because it goes against human nature. People crave control and excitement, yet compounding rewards surrender and boredom. The investor who truly understands compounding learns to do less, think longer, and act rarely. They respect the passage of time as their greatest ally. They know that every unnecessary interruption costs years of progress. The quiet accumulation of wealth through compounding is not about speed. It's about endurance, patience, and the unwavering ability to let time finish the work you started.